Good afternoon and welcome back to NWR Vantage Point Conference. Up next we have Silk Logistics with the company's COO, Danny Aquilina. Before I hand it over to Danny to go through the presentation up on the screen, I'll just remind you that this is more of a sort of quick pitch 101 and more interactive in terms of Q&A, which you can submit through the Q&A panel at the bottom of the screen, and we encourage you to do so. But Danny, with that, I'll hand it over to you to go through the presentation. Thanks very much.
Excellent. Thank you, Simon, and hello, everyone. Appreciate you joining today. So I will jump straight into it. There we go.
Perfect.
Okay, so Silk Logistics is a technology-enabled integrated port-to-door logistics provider. Silk operates in a mature, highly fragmented market, and this is where we see our ability to grow. The advantage of Silk lies in our integrated model that's supported by our technology overlay that provides our clients visibility across the supply line, which we service via a single portal. Silk has the benefit of a highly experienced board and management team who are committed to growing the business to a target of 1 billion of revenue over the next 5 years. We continue to witness growth in all of our key operational metrics. We have successfully leveraged our assets, and in our most recent results released highlighted growth in our total warehouse area, average leased occupancy, billed containers and consignments. We continue to invest in our business and we aim to achieve our growth strategy with resource and capital investment in automation to support our new warehouse sites. Silk has 49 sites operating across the country, and each site stands alone with its own P&L and minimum thresholds of performance. We believe this is a key aspect in managing our performance. The customer segments we service have been strategically targeted as they are defensive in nature and have proven to be recession, as well as more recently, COVID-proof, giving us confidence in executing our strategy in the current inflationary and rising rate backdrop. Our time-certain approach is crucial in the maintenance of our customer satisfaction. In our most recent half-year results, we highlighted renewed customer contracts with a value of 38.1 million annualised. This is supported by the long-term relationships with our customers and the average relationship tenure of 8.3 years with contracted customers, and share of wallet we continue to grow with those customers as a really strong endorsement of the business that we bring to the market. Despite challenging industry conditions, including labour shortages, escalating material costs and our investment in future growth, we've been able to achieve significant profitability growth in the business and maintain underlying margins with a disciplined cost focus. In the first half of this year, we achieved 39.1% of revenue growth, highlighting the strength of our integrated service offering, and we're able to achieve substantial operating leverage with 9.8 million underlying NPAT, with a strong balance sheet of 34.1 million of cash, coupled with strong cash generation, which provides further capabilities for acquisition and expansion, while paying out a 5% annualised dividend yield. Turning to our growth strategy. At Silk, we wish to be the market leader of innovative supply chain solutions through our people and connected networks, making it easy for customers to do business. The business has employed a board-endorsed 3 to 5 year growth strategy that aims to drive Silk towards a $1 billion revenue business as a minimum. Underpinning that growth is our ability to execute on 5 strategic pillars, including providing the quality of service from port to door with a focus on customer satisfaction, safety, innovation, respect, integrity, and passion. Silk's 5 pillars will focus on delivering value, growth, and excellence that are enabled by our people and leadership, with a focus on growing across existing and expanding networks and capabilities enabled by industry-leading technology. We've begun executing our strategic growth projects, including providing a market-leading customer experience with a unified customer solution designed to efficiently receive and address customer requests. It also includes a centralised portal with real-time KPI reporting and self-service portal for clients across all business units. Increasing our share of customer wallet will be assisted by integrated customer solutions. This will enhance our end-to-end supply chain visibility through an integrated technology offering and leverage data-driven insights to optimise the customer experience. Additional warehouse space is coming online in 2024 and 25 with significant automation and capacity for future growth. ESG is a core focus of the business, and Silk has drafted and defined a roadmap to reduce its footprint over time. People remain core to the success of Silk's growth, and therefore we are employing many employee initiatives, including the implementation of systems and recognition and reward programs, which was further highlighted by the establishment of an employee share plan earlier this year. We've been pleased with our growth this year and have made significant investment in strategy execution. We have a level of confidence with our business and the robustness of our business despite challenging market conditions. Our guidance continues to reflect the investment we have made based on our first half results and our progress to date. In the second half, we expect a full year revenue of 480 to 500 million and EBIT post AASB of 35 to 37 million, representing a 4% beat on consensus at the upper end of our range. The rapid growth we've achieved in the past couple of years will ease until we deliver new facilities and capacity over the next 18 months. And as the business emerges from its high growth phase, we'll return to a more typical seasonality in a logistics business. This will be coupled with a return by our clients to a more just-in-time approach to their inventory, which varies from the last couple of years as they have adopted a just-in-case approach. And Simon, that brings me to the end of the presentation.
Perfect. Thanks for the presentation, Danny. Just a reminder, if you did want to ask a question, Q&A button is at the bottom of the screen. But first question, what are some of the important levers you have in the business to adopt to challenging market conditions?
Yeah, thanks, Simon. We have two main levers. One that we refer to as our asset right strategy, in that we have a lot of variable costs in our business, whether that be subcontractors or fleet that are on rental hire. That allows us to respond to changes and protect our margins. The other side is the contracts that we have in place with our customers, where our contracts include what we call a rise and fall calculation. So that allows us annually to pass on increases. And we've been very successful over the last 12 months in particular with significant rises in labour and so forth in passing those rates on to our customers. So that gives us a lot of protection in this particular environment.
Are you witnessing any pushback from customers in relation to passing on costs?
We haven't. We've found that customers have been understanding. At the end of the day, they are experiencing this themselves, and depending on what industry they're in, they're passing their own costs on to their customers. So no, they've been understanding, and our contracts allowed for that to be the case. I do think the next 12 months, we will see an increase though in customers really pushing us to find other ways to help them become more efficient as they cope with costs that have risen over a number of years now.
Oh, that makes sense. You talked about just in case versus just in time.
Yeah.
Where are we in this transition? Are clients holding more stock than they need currently? And how long will this process take?
Yeah. So I guess from what we see, one of the metrics that we look at is what we call our occupancy levels in our warehouses. Through the peaks of COVID, we were, in some of our sites pushing that 100% mark. We were absolutely full. That subsided somewhat, but it hasn't completely come off. So we've been hovering around 90%. What we're finding with customers is they have commitments that are far in advance. So at the moment, volumes are still relatively high, but our early indicator is really what we see come through the ports. And we have seen some volume decline really in this second half of this financial year in terms of import containers. So we do think that the shift has started, and really over the next 12 months, we'll start to see that balance return.
Perfect. Thanks, Danny. Next question. The guidance for FY23 suggests the incremental revenue is at a slightly lower margin overall. What's driving this? And is this growth into more stable revenues?
Yeah, it is. So we have taken on some customers with longer term contracts with strong investment that we've traded off some margin in essence to keep that. But we think over the long term, based on our average 8.3 years, will pay itself back. But costs in themselves are well managed. A lot of it's to do with some key contracts that we've onboarded.
And what's the main risk in the business? Is it freight volume declines, given your cost base is fixed or relatively fixed with leases?
Yeah, that volume, albeit we can make adjustments to protect our margins. So in port logistics in particular, that's highly variable. Where the risk is ultimately in warehouse space, where if volume came off significantly, we've got a higher level of fixed costs. What we're protected by, though, is long-term contracts that are in place. So where we've got the higher fixed portion of our business being warehousing, we are protected by long-term contracts. And what we also have in the background is a pipeline that remains very healthy of additional customers that we're either quoting for or have signaled interests. And that will be a real focus for us in these next 12 months.
Segues well into this question. How's the new business pipeline looking? Any change to the above average win rates? What's the competitive environment like currently, given we're moving back to just in case stocking and potential space capacity?
Great question. I think that the pipeline is healthy. Our conversion has been running, particularly in warehousing. We win 1 in every 2. We don't see that changing. We've had some very recent wins only in the last few weeks, which are fantastic accounts for us. Where I think we will be faced with a bit more competition, though, is in our port logistics sector, which is more transactional and typically less contracted or short-term contracts, so 12 months in nature. What we have on our side is good track record with a lot of the freight forwarders that we work with, and we do a lot in agriculture as well, and agriculture is expecting a good season. But we do expect to come into some competitive set. We just will really strengthen our pipeline and not compromise our service like others may.
And how much capacity do you have in warehousing in terms of revenue upside without needing to take on more costs?
Not a significant amount more. We did take on an additional warehouse in the last 6 months, which has provided a bit more capacity, and we've got 85,000 square metres in the pipe that's coming online progressively over the next 12 to 18 months. But otherwise, we don't have a lot of redundant capacity. So that's fantastic in terms of protecting our fixed costs, but does cap the level of growth that we can drive in that space over the next 9 months until the new warehouses come online.
Well, that'll come around pretty quickly.
We're fast down the track of planning. So
exactly. Can you talk to the reduction in supply chain costs, in particular shipping and freight costs, and how this deflation is being experienced by clients?
Yeah, it's been an incredible reduction in rates from their peaks. Look, for in terms of how our customers are experiencing that, obviously that's been pleasing for them. It does, of course, signal that we do have more competitive tension in that international space, and then that will flow into cartage. Freight forwarders, who are a key customer of ours, are feeling the shift in those rates, again, from the highs of COVID that they had. So I think we will see, in particular for freight forwarders that were very lucrative through COVID, they'll be seeking other ways to reduce price and improve the margins that they're making. So it's going to be critical for us to really drive those long-term partnerships again and focus on the service that we provide.
Perfect. Are your competitors employing similar critical technology to you?
Well, I guess yes and no. I'm not 100% sure of the exact system, suites that they're using, but we use predominantly the top tier. If you ever look at the Gartner quadrant, That's the space that we play in. I think what we're doing, though, that is different that I'd call out is really working on the things that provide us with a competitive advantage and building those in-house to ensure that we retain that IP, and in particular ensure that we're not seen as being transactional in nature, that we actually provide a service and a value that is absolutely worth paying for.
And then final question that we've got here, but you've already addressed a little bit. Just in terms of port volumes, how they're tracking, what do you expect to see there?
Yeah, we've definitely seen some decline, in particular in the import sector. That really started to soften as we got into that January period. It's improved a little bit, but it's still down on where it was last year. We expect that it will pick back up somewhat, but it won't be back to the levels that it was last year.
Sure. And in terms of M&A, how's the company looking at that? What does the landscape look like?
Yeah, look, we're very active in that space. That's a really important part of our strategy and underpins a significant portion of the growth ambitions that we have to $1 billion business. We are focusing at the moment on the distribution arm of our business. So with the three sectors that we have, being port, logistics, warehousing, we also have distribution. Distribution to date is a 4PL broker model. We really believe to round out our port-to-door service, we need to run that as a traditional transport business. So we're actively looking at targets in that space, and we've got other opportunities on the table at the moment. So our in-house corp dev team are out there looking for the right opportunity that strategically aligns and is value accretive.
Right, thanks. And just back to volumes, what does lower inbound mean for Silk?
Lower inbound, well, I guess for us from a port logistics perspective, it obviously challenges the revenue side on that respect. So it's been critical for us to drive a sales focus to ensure that we can capitalise on customers and markets that we may not be in. The offset of that, though, is that we're seeing an increase in the makeup of our export business, and we do quite a bit of work with cotton and grain, and we're seeing that's performing strongly for us, and we're expecting to go into a really strong season in the coming weeks. So a bit of a trade-off on import, a focus on sales and gaining new customers, but also growing that export side of our business.
Perfect. That concludes the Q&A segment. Danny, if there's any closing remarks from you, I'll hand it back to you, but otherwise I'll finish up there.
No, I appreciate everyone's time. Thank you. Thank you, Simon.
Thanks so much, Danny. Thanks all for attending. Cheers.